Hello and welcome to Investment Insight, your clear take on the markets. Let's get started.
Great to be here. Although I have to say, if you've been watching the markets this week, you might be wishing you'd stayed in bed.
You can say that again. I made the mistake of checking my 401k app this morning, and wow,
Yeah.
it is ugly out there. We're just seeing this sea of red.
Across the board.
Stocks, crypto is just plummeting, and even the stuff that's supposed to be safe, like gold, is taking a beating. It feels like there's nowhere to hide.
It really does. It's chaotic.
Yeah.
And frankly, this isn't just a standard, bad week.
Yeah.
We are seeing the kind of volatility, price swings in a single day that we sometimes wait a whole year to see. Investors are spooked.
Right, and when people get spooked, they panic sell.
Yeah.
But that's not what we're going to do.
No.
Our mission on this deep dive is to just take a breath, stop looking at the red arrows, and actually figure out why this is all happening.
Look under the hood.
Exactly. Explain it in plain English so you aren't just reacting, but you're actually understanding.
And according to recent analysis and all the data from this week, especially from the 5th and 6th, there are three massive interconnected shifts happening.
A perfect storm.
It really is.
Okay, so let's map this out. First, we have to talk about AI. We've been in this AI revolution hike phase, but now we've hit a wall. I'm calling it the show me the money phase.
That's a great way to put it. The hype is fading and the bills are coming due.
Okay, second, the everything sell-off. This is what's confusing everyone. Why on earth are Bitcoin and gold falling at the same time?
They're supposed to be opposites, right?
Exactly.
That's a liquidity crisis. We'll get into that.
And finally, number three, the flight to safety. If everyone is selling, where is the money actually going?
Right. It has to go somewhere.
So let's start with the big one, tech.
Let's do it.
For the last couple of years, it felt like any company that just mentioned AI in a press release saw their stock jump like 20%.
It was pure adrenaline. Just say the magic word.
But the mood has completely flipped this week. What changed?
The mood shifted from, let's call it blind excitement, to just pure sticker shock.
Sticker shock.
We've gone from dreaming about what AI could do to worrying about what AI actually costs. And the catalyst, the thing that woke everyone up, was Amazon.
Yeah, I saw the headlines. Walk us through those numbers. They announced their spending plan for 2026.
They did. It's called capital expenditure, or CapEx. It's the budget for building new stuff factories, servers, infrastructure.
Okay.
In 2025, Amazon spent about $131 billion, which is already, a staggering amount of money.
That's huge.
But for 2026, they announced they're planning to spend $200 billion.
$200 billion just to build stuff?
Yep. And to put that in perspective, that is roughly the entire GDP of a country like Greece.
An entire country's economy.
In 1 year, on servers, chips, and data centers.
Okay, hold on. I need to wrap my head around this. That's a lot more than just cardboard boxes for Prime delivery.
That's the thing. It's not for boxes. It's for AI. It's massive data centers, custom chips. They're even talking about nuclear power to run these things.
So let me try an analogy. Tell me if this works.
Go for it.
It feels like you have a friend, Dave, and Dave decides he's going to drive for Uber.
Okay, sensible idea.
But instead of using his, Honda Civic, Dave goes out and buys a brand new Ferrari to pick people up.
That is the perfect analogy.
So, well, let me play devil's advocate. Maybe if Dave's the only guy with a Ferrari, he gets all the best customers, all the best tips.
That's the bet Amazon is making. But the bank, or in this case the investors, they're looking at Dave and saying, hey, that is a really cool car, but are you actually going to make enough money on $15 rides to pay for the gas and the insurance and that massive loan?
And right now the market is screaming, maybe not.
Exactly. It's demanding what Wall Street calls return on invested capital, ROIC.
The receipts.
Show me the receipts. It's no longer enough to just say we're doing AI. You have to prove you can actually monetize it.
And this is creating a split in the tech world, isn't it? Because not all tech stocks are crashing the same way.
Correct. We're seeing two paths emerge. Path A is Nvidia.
The shovel seller.
Exactly. Nvidia is selling the shovels in the gold rush. As long as Amazon and Microsoft are spending billions on chips, Nvidia makes money. If their stock holds up, the market feels, a little bit safer.
Okay, so that's path A. What's path B?
Path B is companies like Apple or Alphabet, Google's parent. Investors are looking at their cash flow. They're asking, do you have a real profitable business-like iPhones or search ads that can pay for your giant AI gambling habit?
So it's a stress test. But there was another piece of data that really scared me.
The software sector?
Yes. The software and data services sector lost nearly $1 trillion in value.
Trillion with a T. It's a bloodbath.
Why? I thought AI was supposed to help software.
That was the hope. But now investors are fearing something called cannibalization.
Cannibalization. That sounds gruesome.
Financially, it is. Think about the last decade. The model was software as a service, SaaS.
Right. You pay a monthly fee for every employee who uses the software, a seat.
Exactly, seat-based pricing. But what happens if one AI agent can do the work of 10 employees?
You don't need 10 seats anymore.
You might not need the software at all if the AI can just do the task itself.
Oh, I see. So AI isn't just a feature in the software. It could be a complete replacement for it.
And that's the terror for investors.
Yeah.
It could destroy the pricing power of these massive software companies. No one knows if the new business model is profitable yet.
Wow. Okay. So the free money is gone, tech is spending a fortune, and AI might be eating itself.
Which brings us to disaster number 2.
Right. The everything sell-off. Let's talk about what happened on February 5th and 6th.
It was brutal.
Bitcoin dropped, what, 12.6%? Smashed right through $60,000. But before we get to Bitcoin, you have to explain the gold thing.
Why did gold fall too?
Yes. If the world is on fire, isn't gold supposed to be the safety blanket?
In a textbook, yes. But in a real crisis, cash is king. We have to talk about liquidity. Let me give you another analogy.
Okay.
Imagine a forced yard sale.
A forced yard sale.
I'm listening. Let's say you're a trader. You borrowed a lot of money. That's leverage to buy a ton of crypto. But then crypto crashes.
Ouch.
Now your broker calls you. It's the dreaded margin call. And they say, you owe us $10 million by 4 p.m. today.
You need cash. Fast.
You can't sell your crypto. The price is tanking. No one's buying. You can't sell your house in an hour. So what do you sell?
The one good thing you have left.
Your gold.
Ah.
You don't want to sell it. You love your gold.
Ugh.
But you have to sell it to pay for your bad bets. It's the only thing liquid enough to turn into cash instantly.
So when gold falls with everything else, it's a huge red flag that people are desperate.
It's a sign of real panic, a liquidation event.
That makes perfect sense. Okay, so let's loop back to Bitcoin. Why that massive 12% drop?
It was a perfect storm of economics and politics. First, the economics. We have to look at the Bitcoin miners.
The people running the computers, how are they doing?
They're doing terrible. The latest data shows the average cost to mine one single Bitcoin electricity, hardware, all of it is now about $87,000.
Wait. $87,000 to make one coin.
Yep.
But the price on the market is under $60,000.
Correct.
So every time they make one, they lose nearly 30 grand.
They are bleeding cash.
Yeah.
And that creates a death spiral.
How so?
These companies have bills to pay. They're operating at a massive loss. So they are forced to sell the Bitcoin they already have in their savings just to keep the lights on.
So the biggest believers are becoming the biggest sellers.
Exactly. And then you add the political layer on top of that. We have to talk about the Treasury Secretary, Scott Bessent.
Right. Under the Trump administration, the crypto world thought he was going to be their best friend, didn't they?
They did. They were hoping for friendly rules, maybe even the government buying Bitcoin for a reserve.
But he poured cold water on that idea.
He did. He basically took on the role of the adult in the room. He made it very clear there is no government put.
A put is like a safety net, right?
Yeah.
A bailout.
It's a bailout. He's saying if Bitcoin goes to zero, we're not going to save you. He even called out the nihilists who want zero rules, but then, cry for help when it all goes wrong.
So if you want the Wild West, you have to deal with the bandits yourself?
Pretty much. But to be fair, he didn't slam the door completely shut. He did mention a potential strategy of using seized assets.
Bitcoin they took from criminals?
Right.
Right.
Using that to form a strategic reserve. So it's a little glimmer of long-term hope, but it was definitely not the message the market wanted to hear right now.
Okay, so let's recap where we are. Tech is spending a fortune, investors are angry, Bitcoin miners are broke and selling, and everyone else is selling their gold just to survive.
That sums it up.
Which brings us to the final piece of the puzzle. If everyone is selling, where is all that money going?
This is the most critical concept to understand what happens next.
So usually we talk about sector rotation, selling tech to buy energy. Is that what's happening?
That's a great question, but no, this isn't rotation. This is deleveraging.
Okay, what's the difference?
Imagine you're at a casino. Rotation is moving your chips from the roulette table to the poker table.
Okay.
Deleveraging is cashing out all your chips, putting the money in your pocket, and walking out the front door.
The money is leaving the game entirely.
Yes. And it's going to the safest, most boring assets on the planet.
Cash and T-bills.
Cash and short-term U.S. government bonds. When the market is this crazy, investors stop caring about return on capital. They only care about return on capital.
Don't make me rich, just don't make me poor.
Exactly. And this causes these massive global shockwaves.
The data mentioned something about Korea.
Yeah, the Cocos PI, the Korean stock market, it triggered a circuit breaker this week.
That's when they have to physically stop trading because it's falling so fast.
Yes. It dropped over 5% in minutes. Because when U.S. investors pull their cash back home to safety, liquidity just vanishes everywhere else. When the U.S. sneezes, the world catches pneumonia.
That really shows the scale of this. It's a global liquidity problem.
The market's mantra right now is safety and liquidity over growth and dreams.
Safety and liquidity over growth and dreams. I think that's the title for this chapter in the history books.
It fits perfectly.
Okay, we have covered a massive amount of ground. Let's try to bring it all back together for everyone listening.
Let's do it.
Okay, point one. The AI honeymoon is over. Amazon's $200 billion spending plan was the wake-up call. Investors want to see profits, not just cool tech.
Right. And they're scared of cannibalization.
Point two, the everything sell-off. Bitcoin crashed because the miners are unprofitable, and that forced selling dragged gold down with it as people scrambled for cash.
Spot on. A classic liquidity crunch.
And point three, the great deleveraging. Money is fleeing stocks and going into cash and government bonds, and that retreat to safety is hurting markets all over the world.
That is the landscape. A very harsh reality check.
So as we wrap up, what's the one thought you want to leave everyone with? What's the big question they should be asking themselves?
Here's the question. We know the easy money is gone. We know AI costs are astronomical. So if you look a year down the road, which of these tech giants actually has the moat to survive?
The moat, like their defenses.
Exactly. What protects your castle? If profit margins are shrinking because everyone has to spend billions on AI, who can actually afford to bleed cash for a year or two?
Is it the trendy startup or
is it the company with a massive, boring bank account?
So cash might be king again.
I think we're about to find out that boring cash flow is the most exciting asset you can possibly own. When the tide goes out, you find out who's swimming naked.
And the tide is going out fast.
Very fast.
That is a sobering but very valuable perspective. Sometimes just holding cash is the smartest trade.
Absolutely.
Well, that wraps up this deep dive into the market's reality check. We hope you feel a little less panicked and a lot more prepared for what's coming.
Stay safe out there.
Don't forget to subscribe and hit that like button.